I need you to lock in right now, because what I'm about to show you isn't a prediction, it isn't doom porn, and it's definitely not some YouTube fantasy made for clicks. This is a real-world financial threshold that has already been crossed inside the United States consumer credit system. And once this threshold is crossed, history shows there is only one direction the damage moves. It spreads, it accelerates, and it takes down everything that's connected to it. Credit card default rates have now hit 15% nationwide. Let that sink in. 15%. That means roughly 1 out of every 7 credit card accounts is now seriously delinquent, 90 days past due. And if you think that's bad, Chicago is now reporting a 22% default rate. That's more than 1 in 5. And no, this isn't just a Chicago problem. Chicago is the canary in the coal mine. It's the first crack in the glass, the same crack that spreads across the entire system. But here's what the mainstream financial media will not tell you. Because they can't, or because they don't want to. Regional banks are holding over $580 billion in credit card receivables. And 68% of that exposure sits with institutions that have less than $250 billion in total assets. These are not the JP Morgans. These are not the Bank of Americas. These are the regional and community banks that are already bleeding from commercial real estate losses, already drowning in unrealized bond losses, already fighting deposit flight. And now, they're about to get hit with a consumer credit crisis that will make their current problems look manageable. This is not a temporary spike. This is not seasonal. This is not a soft landing bump. This is the beginning of a cascading default cycle. A default cycle that forces banks into insolvency, triggers emergency liquidity programs, and accelerates the bail-in framework that most depositors still don't even know exists. And in the next few minutes, I'm going to break down exactly why this default wave is different from anything we've seen since 2008. Why the structure of credit card securitization creates a hidden time bomb. And most importantly, the 3 asymmetric moves you need to execute now, before the market wakes up. Because once the market wakes up, it's too late. By the end of this video, you'll have a clear framework that separates signal from noise, and a real action plan that most people won't discover until the crisis is already raging. So stay with me, because what I'm about to show you is not something you're going to hear on CNBC. And the window for positioning is closing fast. Now, before we even touch the current data, you need to understand one foundational truth that governs every modern credit crisis. And if you understand this one truth, you will never look at credit markets the same way again. Credit does not collapse in a straight line. Credit collapses in an acceleration curve. Slow, 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 and then suddenly violent. This is what I call the credit acceleration model. In normal times, defaults happen at predictable levels. Credit cards might run 2 to 3%. Auto loans 1 to 2%. Mortgages under 1%. Banks price these losses into interest rates and fees. It's manageable. It's expected. It's built into the system. But once defaults cross a certain critical threshold, something changes mechanically. The banks don't tighten gradually. They don't adjust policy. They slam the brakes. Credit lines get cut overnight. New approvals collapse. Limits shrink. And borrowers who are barely hanging on lose the ability to roll over their debt. So they default. That pushes default rates higher, which forces banks to tighten even harder, which forces more defaults. And what you get is not a trend. You get a feedback loop, a self-reinforcing machine. And once that machine starts, it is extremely difficult to stop without massive external intervention. That's the thesis. We have crossed the threshold. 15% nationally, 22% in Chicago. These are not peak numbers. These are early stage numbers inside an acceleration phase. And the banks most exposed are the banks least capable of absorbing the damage, because they're already carrying hidden losses everywhere else. So now let's talk history. Because the patterns are not new. The names change. The headlines change. But the mechanics never change. The first parallel you need to understand is the savings and loan crisis of the late 1980s and early 1990s. Most people don't even remember this crisis. But it's a perfect mirror of what's happening today. Back then, savings and loan institutions, basically regional banks, went on a lending binge. They were deregulated. They were encouraged to take more risk, and they loaded up on commercial real estate and consumer credit. Then interest rates spiked. The value of their portfolios collapsed. Borrowers couldn't refinance. Defaults accelerated, and the system started falling apart. Between 1986 and 1995, over 1,000 savings and loan institutions failed. The government had to create the Resolution Trust Corporation. Taxpayers paid over $130 billion. But here's the key. The people who got rich didn't get rich by panicking. They got rich by understanding the timeline. They avoided the collapsing banks and waited for the forced liquidation. They bought distressed assets at 30 to 50 cents on the dollar. They held through recovery, and they built generational wealth. Credit crises don't just destroy. They transfer. They transfer wealth from the uninformed to the prepared. The second parallel is the 2007 to 2009 subprime mortgage crisis. And this one is even more relevant because it involved consumer defaults cascading through securitization. Banks originated garbage mortgages, packaged them into mortgage-backed securities, sold them worldwide, and the entire system was built on one assumption. Housing prices will keep rising, so borrowers can refinance. But when housing prices stopped rising, the system snapped, defaults spiked, the securities collapsed, and the AAA-rated products turned out to be poison. Subprime defaults went from around 6% in early 2007 to over 25% by 2009. Bear Stearns died. Lehman died. Washington Mutual collapsed. The Fed and Treasury stepped in with TARP, $700 billion. And once again, the people who made fortunes were not the people watching headlines. They were the people watching the credit structure. John Paulson made $15 billion. Michael Burry saw it early. Calbay saw it early. They didn't guess. They understood the acceleration model, and they positioned accordingly. Now here's the terrifying part. We are watching the same structure form again. But this time it's not mortgages. It's credit cards, and the scale is enormous. As of the most recent data, total outstanding credit card debt in the United States has crossed $1.77 trillion. That's an all-time high, higher than the 2008 era, higher than any point in history. The average balance per borrower is now above $6,500, and the average interest rate is 22.8%, the highest in over 4 decades. So imagine this, a family already crushed by rising rent, rising food, rising healthcare, rising energy, now paying 22 to 28% interest on basic survival. This is not consumer spending. This is survival spending. And here's where it becomes lethal. The national default rate, 90 days past due, has hit 15%. During 2008, the peak was 13.6%. We are already above the 2008 peak. And we're not even in a recession yet. That's the part nobody wants to say out loud. This is happening while unemployment is still relatively stable. So what happens when unemployment rises? What happens when layoffs accelerate? What happens when hours get cut? What happens when businesses start collapsing? The default rate doesn't go sideways. It explodes. And Chicago's 22% is proof. Because Chicago isn't special. It's just early. Now the question becomes, why? Why is this happening right now? There are 3 structural drivers. And when you understand them, you realize this crisis is not a maybe. It's already baked in. The first driver is real wages. Adjusted for inflation, real wages have been declining for a huge portion of Americans since 2021. Yes, wages rose nominally, but essentials rose faster. Food, energy, housing, insurance, healthcare, everything. The bottom 60% is being squeezed, and credit cards became the bridge. A bridge that worked as long as minimum payments were manageable. But at 22% interest, minimum payments become a trap. The balance doesn't shrink. It grows, even if you pay. So people hit a wall. Not because they're lazy, not because they're irresponsible, because the math no longer works. The second driver is student loan payments resuming. During the pandemic, student loan payments were paused. Millions of borrowers suddenly had an extra $200 to $400 per month. Some used it to survive. Some used it to pay down debt. Some used it to stay afloat. Then late 2023 came. Payments resumed. And it was like someone pulled the plug on their budget. For households already running tight. That was the tipping point. And we saw the default acceleration begin. Not slowly, not gently, violently. The third driver is the one most analysts completely ignore. The savings buffer is gone. During 2020 and 2021, stimulus checks and lockdowns created a surge in savings. The personal savings rate hit 33% in April 2020. Historic. But then inflation came. Stimulus ended. And people started draining savings to survive. Now, excess savings is basically zero for the median household. And for the bottom 40%, savings are negative, meaning they owe more than they have in liquid assets. So what happens when the buffers are gone? When the interest rates are brutal, when the payments resume, you get exactly what we're seeing now, a default acceleration. Now let's talk about the real danger, the banks, because this is where people misunderstand the situation. Credit card debt is not just consumer pain. It's bank balance sheet poison. Credit card lending is concentrated in two groups, large money center banks and regional banks. The large banks have diversified revenue streams. They have massive liquidity. They have political protection. The regional banks? They don't. And according to FDIC call report data, regional banks between $10 billion and $250 billion hold around $395 billion in credit card receivables and securitization exposure. Their net charge-off rates are averaging around 9.7%, approaching 2009 levels. But here's the trap. Charge-offs are backward-looking. They reflect default from 6 to 9 months ago. The 15% default rate we're seeing now has not fully hit bank earnings yet, meaning what you're seeing is not the peak damage. You're seeing the calm before the earnings collapse. Banks know this. They're increasing reserves, but not fast enough. And that creates the most dangerous scenario in banking. Under-reserved losses. Because once the losses hit, capital ratios get destroyed. And once capital ratios get destroyed, depositors panic. And once depositors panic, banks D. Now let's add the hidden bomb. Credit card asset-backed securities. UPS. This is where banks package credit card receivables into securities and sell them to investors. Pension funds. Insurance companies. Institutions. People who thought they were buying safe yield. The credit card ABS market is over $350 billion. And the structure works as long as defaults stay stable. But when defaults spike, cash flows collapse. Lower tranches get wiped. And in extreme cases, even senior tranches get impaired. Sound familiar? That's 2008. Just a different wrapper. And right now, spreads on lower-rated credit card ABS have widened by over 300 basis points in the last 6 months. That is the market screaming. That is the market saying, this is not safe anymore. And if this continues, the securitization market freezes. If it freezes, banks can't offload risk. They must hold everything on balance sheet. That ties up capital. It reduces lending. It tightens credit. And guess what tightening credit does? It creates more defaults. Again, feedback loop. Now we need to talk about what happens next, because this is where timelines collapse. Banks facing rising defaults have 3 options. Option 1, they tighten credit standards, cut limits, reject new borrowers, shrink credit lines. Option 2, they raise interest rates even higher to compensate for losses. But higher rates create more defaults. Option 3, they seek emergency capital. Private markets, government facilities, Fed liquidity. And here's the truth. All 3 are already happening. Underwriting is tightening. APRs are rising above 25% for subprime. And behind the scenes, regional banks are quietly increasing reliance on emergency liquidity. This is not speculation. The data is there, and stress is rising. Now comes the moment most people never see coming. What happens when reserves aren't enough? What happens when emergency borrowing isn't enough? What happens when a bank becomes insolvent? This is where bail-ins enter the conversation. And I need you to understand this clearly, because most depositors are living in a fantasy. Under the Dodd-Frank framework and FDIC resolution authority, banks can be placed into an orderly liquidation process. And in that process, unsecured creditors can be forced to absorb losses, including depositors above the $250,000 FDIC insurance limit. Deposits can be converted into equity to recapitalize the institution. That's not conspiracy. That's law. It's been used internationally. Cyprus, Italy, Spain, and the framework exists in the United States. The public doesn't talk about it. Media doesn't explain it. But it's there, waiting. And when the next wave of bank failures begins, it becomes very real. So what do? This is where most people freeze. They get scared. They doom scroll. They panic. And they lose. Because credit crises don't reward fear. They reward preparation. So here are the 3 asymmetric plays. The first play is simple. Reduce exposure to regional banks immediately. If you have deposits above the FDIC-insured limit in any single institution, especially a regional bank, diversify, spread deposits, move to stronger institutions, or move a portion out of the banking system entirely. Because keeping uninsured deposits in a stressed regional bank is an asymmetrically negative trade. You're earning 3 to 4% and risking a catastrophic event. That's not smart. That's not safe. That's gambling with your liquidity. The second play is distressed credit and selective financial equity. Because not every bank will die. Some will survive. Some will dominate after the shakeout. When panic hits, everything sells off, even quality. That creates opportunity. Buying strong financial institutions at crisis valuations can create massive returns. Also, distressed debt investors can buy defaulted receivables at 20 to 30 cents on the dollar. And work collections. This is specialized, but it's real. And the asymmetry is insane. The third play is the systemic hedge. Physical precious metals. Gold, silver. Because they have no counterparty risk. They can't be bailed in. They can't be frozen. They don't depend on a bank. And historically, they perform extremely well when confidence in the financial system breaks. In 2008, gold went from $800 to over $1,900 by 2011. Silver went from $9 to nearly $50. And why? Because the policy response to credit collapse is always the same. And this is the part most people don't understand. Central banks don't fix credit crises. They inflate them away. They print. They ease. They inject liquidity. And that response is inflationary by design. So now let's talk about the policy response. Because it's predictable. The Federal Reserve cannot allow a credit-driven banking crisis to spiral. They will intervene. First, liquidity. Emergency facilities. We're already seeing this. Second, rate cuts. If defaults rise and the economy weakens, the Fed pivots. Third, quantitative easing. And if the crisis deepens, they restart asset purchases. Treasuries, possibly even consumer ABS. They will inject liquidity. They will debase the currency. And that pushes investors into hard assets. This is the playbook. And if this accelerates, and here's the key, by the time the Fed pivots, the biggest gains are already gone. The market prices it in fast. That's why positioning early matters. Now I want to give you a real action checklist. Not vague advice. Not be careful. Real steps. Step 1. Assess your deposit exposure. If you have more than $250,000 in one institution, especially regional, diversify immediately. Step 2. Build a position in physical gold and silver. If you don't have any, you're naked in a systemic crisis. A minimum allocation of 10 to 15% of liquid net worth makes sense. And if you understand the asymmetry, you already know it should be higher. Step 3. Start researching distressed opportunities. Banks, credit funds, high-quality institutions trading at depressed valuations. The best time to buy is when others are panicking, and we are entering that phase. Step 4. Reduce exposure to consumer discretionary stocks. Highly leveraged companies. Businesses dependent on cheap credit. In a credit contraction, These get destroyed first. Step 5. Stay informed. Monitor the data. Defaults monthly. Bank earnings quarterly. Fed meetings every 6 weeks. This is not a set-and-forget environment. This is an active cycle. And if you're watching, you can move before the crowd. Now I want you to answer one question in the comments. Do you believe the Federal Reserve will allow this credit crisis to fully play out? Or will they intervene early? Because the debate in the macro world is intense. Some believe the Fed will act fast. Others believe inflation traps them, and they'll let it burn longer before stepping in. Tell me where you stand, and if you found this breakdown valuable. If you understand what we just covered is not something you're going to hear on mainstream financial media, then do 2 things. First, subscribe and turn on notifications. Because this channel is built for real-time analysis of credit markets, banking stress, and asymmetric opportunities. We go deep, we go early, and we focus on actionable intelligence. Second, share this video with anyone you know who has large deposits in regional banks, or anyone who still thinks credit card defaults don't matter. Because the people who get hurt most in this crisis are the ones who don't see it coming. The credit card default wave is here. The banks are trapped. The acceleration phase is just beginning. And the only question is, are you going to recognize the pattern in time? Or are you going to be one of the people who learns about it when it's already too late? Take action, stay informed, and I'll see you in the next one.